Hello, everyone. Welcome. So I am Kamal Hassan. I'm one of the co-founders of Loyal VC, an evergreen venture capital fund global, which has been running since 2018. There's a number of things we tend to read a lot, are fairly interested in what's going on in the venture market as a whole. So this is simply a chance to give you a chance to hear some of our thinking on the market, things that are happening. We'll start with about a 25-minute presentation and then move to sort of Q&A, general discussions from there. If you want specific information about Loyal, I'm happy to answer a question or two in here. But if you want to find out a lot about our fund, we do other investor information sessions. Just go to our website at loyal.vc. If you want to know more about our fund, this will be more about the industry as a whole. But yeah, and I think we're probably pretty good for time. Let's get started now, and anyone else who joins can join later. So welcome to Understanding Today's Venture Market. Now, first thing to look at is how entrepreneurs see today's venture capital markets. And we have monthly calls with hundreds of entrepreneurs at Loyal. It's just the way we run our operations. And if you look at the repeating messages we get over and over from those entrepreneurs, you hear comments like, it's really tough to raise money right now. And when investors do want to come in, they want to come in at the last valuation. Even though my business has advanced significantly, why isn't my valuation going up with the business advancing? And then you hear from people, people who sort of get a bit discouraged by this and say, maybe now is not the right time to raise money. Maybe I should just focus on my business and not raise at the moment. So this is the things which the entrepreneurs are saying, feeling what is going on in the market as a whole. Let's show you some of this. So the first thing that's going on in the venture capital market is returns in venture capital have been down in the recent past. You can see after a high at about December of 2021, it dropped to June of 2024 down to a low, and it went from a high of sort of 340 down to a low of 250, off about 30% or so. So this has been a very significant drop in the this is the venture capital index, but of course this also is reflected in the valuations of companies. If the index is coming down, that means the holdings of the venture capital companies are coming down. That means valuations have been dropping. So this is really explains why entrepreneurs are seeing the pressure on pricing. It's because these valuations have been coming down. Now, if you think about things from an investor's point of view and trying to understand what to do in today's market where these prices are coming down, there's really three types of strategy you can follow, and really depends on who you are. There's a group of people who are the momentum investors. And momentum investors like to invest in things when the recent returns are high. Here's something that's been doing really well. It's going higher and higher all the time. Let's hope it continues to do well, and let's invest in this today. And if you are a momentum investor looking at the early stage VC market, well, you don't want to be investing in early stage VC right now. It's gone through a low. You could be looking at late stage VC, which is very tied to the returns of public markets. And both public markets and late stage VC are currently at record highs. But early stage VC is not interesting. And honestly, this is the way a lot of people think. I call this the masses because a lot of us emotionally and intellectually want to do that. There's a second category of investors who are the value investors. Value investors like to invest when the price is low, and they're hoping that if the price of something's low, it's going to revert to the mean. And if you are a value investor, now looks like a great time to be investing in early stage VC because the price seems to be down at record lows and you can hope it reverts back to the mean. Now, this type of investor is a contrarian, almost by definition, because you are doing what other people aren't so interested in doing. You are going contrary to the market. It's pouring into other assets, and you're saying, no, let's look at what's out of fashion. Now, there is a third type of investor who we'll call the steady investors. And these are people who do not try to time the markets at all. They say, look, I just want to set up a good portfolio, a good asset allocation mix, and I'm just going to keep investing steadily over time. So What's the advice in today's market? Well, doesn't matter what the market is, you should just keep investing steadily in a good mix of assets. We can call these people the disciplined. But this is really, you've got these three types of investors, these three ways of thinking about the market. And most people are momentum investors, and it may not surprise you to see that, guess what? As the price of venture capital has come down, and the two are clearly correlated, the capital going into venture capital has dropped by 90% from Q4 of 2021 down to Q2 of 2025. So there's been a dramatic drop in the amount of capital going into venture capital. This is why you need to be a contrarian to invest in venture capital currently. And of course, that's what a value investor does. They look for what's out of fashion. They look where nobody else is, and they try to choose the time when the market is down to put things in to add to that asset. Now, you may be asking, okay, great, this is the amount of capital going in has dropped. Is that solely a reflection of the returns? The other thing which we want to share with you here is just to look at a little bit what's going on with IPOs. And you can see the number of IPOs in the US per year peaked in 2021 and then dropped again in 22 to 24 so it was over 1,000 IPOs in 2021, under 200 IPOs in both of 22, 23, and 24. And it is just starting to come back again right now in 2025. So you can see there's been a massive drop in the number of IPOs. And if you want to sort of understand why this matters, you need to look at the traditional venture capital fund structure. So your traditional institutional venture capital fund is a closed-end fund. They raise a bunch of money. They then need to go out and invest that money over a fixed period of time. And when they've exited all the investments, they shut down the fund. Now, on paper, a traditional venture fund is an 8-year fund. The traditional way is an 8-year fund with 2 extensions of 2 years each. So typically it means a fund is supposed to shut down in 10 to 12 years. Now, in practice, and this is data we have back in 2024, in practice, 40% of venture funds are taking over 16 years to shut down. And I'll give a good example. I've got a friend of mine, a buddy from MBA, who is one of the top tech VCs in France. His fund has been doing exceptionally well. He is now, I believe, on Fund 4. He has still not shut down his fund number 1 because the very best deal in that fund, I mean, it's the one that made the fund, the one that made his reputation, the investment that has allowed him to raise funds 2, 3, and 4, but he still hasn't exited that deal. And the thing is, IPOs are a great way to exit your top deals. Venture capital is a home run business as traditionally practiced. You make the majority of your profits from that single best deal. So you think very carefully about the price you're exiting that top deal at. And what happens is you may have a secondary market buyer or an acquirer who wants to buy that cheap, but they're not willing to pay full price. And IPOs are a great way to exit those top companies. And of course, if you think about a company like Stripe, for instance, there's massive competition concerns when you think about any potential acquirers of companies like Stripe. So if you've got the IPO, wonderful, then you're going to get the cash back into the venture fund to allow the venture fund to shut down and redistribute that to all its investors. Now, if you don't have IPOs, funds are taking longer to shut down, hence the 40% of them taking 16 plus years. And if the fund doesn't shut down, it doesn't give money back to its investors, and those investors don't have the capital to recycle back into the asset class. Now, the good news, and you saw a little bit of it on the previous graph, is that the IPO market seems to be in the process of rebounding. So we've got here, this is a headline from the Financial Times a number of weeks ago, talking about the US listings market bursting back to life with the busiest week in 4 years. So one could assume as IPOs come back, money's going to go back to the limited partners. That will go back into venture capital, and potentially we will see the start of a rebound now. Now, the one thing to watch out for when money goes back is that the venture capital industry right now is very, very concentrated. The capital which is going in, 75% of venture capital is going into the top 30 firms. And those are the top 30 firms by size. I'm not saying they're the top 30 firms by returns. I'm just saying top 30 funds by size. And the thing is, when you look at these, over half these funds are over $1 billion in size. And if you look at, and they raised over $1 billion, so this one fund is over $1 billion. And if you're going to do, I mean, your average VC is doing 15 or 20 deals out of a fund. If you have $1 billion fund and you're doing 20 deals with that fund, you are allocating $50 million per deal. And okay, maybe your first check is 25 million, you reserve 25 million for follow on. But the bottom line is, by definition, 75% of the money is going into growth stage funds, and some fraction of the other funds here are also growth stage funds. So you end up with very little capital at the seed stage. Now, there still are a handful of mega funded seed deals, because if you're a big fund, you're going to write a large initial check whenever you can. And just to give you a funny little stat here, Loyal was tied with Sequoia last year as the 7th most active early stage venture investor in the world. And that's our fund, Loyal. We are a tiny fraction of the size of Sequoia, but it is interesting. You still see some of these big funds who are really desperate to keep deal flow. And really the reason someone like Sequoia invests in seed deals is they're trying to get preferred deal flow, early access into companies to build a relationship, to get preferred access to deploy more money later, which, by the way, is exactly Loyal's strategy. I mean, we're called Loyal VC because it's about investing early to build the loyalty. So you do see some of these mega funded seed deals. If you are a entrepreneur, you of course dream of getting some of these deals, but it is really a money flooding to growth stage, relatively little into seed deals right now. Now, what the industry as a whole has been doing recently is they've been waking up to the fact that there are two pools of capital, institutional and private wealth. Now, I talked about the institutional capital. When I talked about sort of venture capital and what's going on in the industry, I'm really talking about institutional capital. If you look, and this is where alternatives are allocated, and alternatives, basically everything other than the stock market, bonds, and real estate. This has been traditionally an area that pension funds, sovereign wealth funds, endowments really focus on. In fact, endowments allocate over half their money to alternatives, including venture capital, private equity, other liquid alternatives, or other marketable alternatives generally. But what has been going on is these are the people whose money has been locked up because companies aren't investing. They haven't been, companies aren't exiting. They haven't been able to reinvest their capital back into venture capital. And the same thing's been going on in private equity. So a lot of people have woken up to the fact that, hey, there is as much money in private wealth as there is in institutional wealth. So why not start to target this private wealth market? And the other thing which has been going on has been the pull from the individual side. That individuals are starting to wake up to the fact that if you only invest in the stock market, you are frozen out of a lot of wealth creation. Now, this shows you history of a series of companies who were launched at different years and then listed publicly. So like the top companies in the stock market started off as venture capital funded companies, people like Apple, Microsoft, Amazon, Nvidia, Google, Tesla. But if you take a look at what happened, the venture capital investors in them earned anywhere between 10 and 600 times their money back, typically sort of a couple of 100x, sort of 50, 100x is what they earned on the deal. But if you look at what happened in all of these companies after they listed publicly, you could buy Amazon when it listed publicly, and you would have made 3,000 times your money back to today, 30 times more than the venture capitalists did who funded it. Look at what happened ever since sort of 2011, 2012-ish, when you had legislation like Dodd-Frank went into place. Look at companies like Facebook or Uber. When they actually listed, the private market was earning 15, 20,000 times their money back on them. And the public investors were only getting a fraction of the wealth creation. They're no longer, I mean, if you invested in Facebook, you didn't get the same 1,300x that you got when you invested in Google when it listed. You only made 20 times your money back. That money went into the pockets of private investors. And you look at stuff like SpaceX and OpenAI, where the private investors in them have already earned thousands of times their money back, and they are unavailable to the public markets. So this has been a big shift. So the people who do private equity and venture funds are saying we need to target individuals, and individuals are saying, hey, I want to get into these companies. I can no longer afford to wait for them to go public. So what we're seeing now is the emergence of a different kind of fund. So we're seeing what we're seeing is semi-liquid evergreen funds. And the reason why semi-liquid evergreen funds is emerging is individual investors don't like the idea of the closed-ended fund, where in theory I exit in 10 to 12 years, and in practice I'm potentially exiting in 16 plus years, as 40% of funds do. So they're saying, I don't want to lock my money away for 10 to 15 years, especially because the wealthier individuals tend to be older individuals, and they want to have potential access to their money as life changes, and they want access to funds to fund their life changes. So what has been going on is people have now been launching these semi-liquid evergreen funds. And this has become a real trend you can see in three areas here. So there's about 16 trillion in institutional funds, private equity, venture capital, some real estate, some credit, some infrastructure. So this is what the institutional funds look like. It is only in 2024, only about 0.4 trillion, I mean 400 billion, 0.4 trillion. So a fraction in semi-liquid evergreen funds, but this is by far the growth area. This has started in credit funds, real estate funds, and private equity. You can see venture capital is 0.5% of semi-liquid, but private equity, I mean, your KKRs on downwards pretty well. Any KKR, Apollo, any big private equity fund you want to name has a semi-liquid evergreen private equity offering. We talked recently with an institutional investor in France, very conservative, who we've been in touch with for a while because, I won't give more details on them, but when we had our last meeting with them, they said they are launching a semi-liquid evergreen private equity fund, even though they're really conservative, because they said you are no longer relevant if you don't have such a product in today's market. And it is because of this interest for individual investors to give them the product which they need. Now, a large chunk of that 0.5%, which goes to venture, has gone to a large American firm called Stepstone, which launched in 2022 with their evergreen quarterly semi-liquid product. I think they're well over $1 billion. I think they're close to $2 billion in assets under managed. And what this fund is it's largely a fund of funds. They have over 1,500 underlying portfolio companies. They're invested in 60 different managers. They just allocate money there. The big thing now, this is our fund Loyal is also an evergreen quarterly semi-liquid fund, diversified $50,000 minimum, pretty well identical. We've been running this since 2018. Just to compare the two, you can see Stepstone is a very US focused fund. Less than 8% of their money is outside the US, whereas in our case, it's 70%, or outside North America, our case, 70% outside North America. And then you have the big differences. You have a fund of funds versus a direct investment. So you have a different fee level if you're dealing with a direct investment versus a fund of funds. Now, we are actually, as a fund, rolling out a new class of shares to match our industry peers. So we traditionally have had a class of shares which focuses on optimizing for returns. We don't carry a liquidity sleeve. Why have a drag of undeployed cash? We make distributions to all investors before redemptions. We're trying to reward our long-term holders by them getting access to money before anyone else can redeem. And then we gate redemptions as a function of subscriptions. We have heard from the market, from the large established players, that look, there is a structure people want to see in these evergreen funds. So we're actually just launching right now a new class, a Class B, which offers more liquidity. It's really focusing on optimizing for liquidity, which you do by keeping a cash liquidity sleeve, by prioritizing redemptions over distributions, and prioritizing using 100% of new money in to fill subscriptions. And then you will still gate as a percentage of the sleeve per quarter. But that is something which we are just launching right now. And this gives you a sense of the type of structure which is out there in the industry for this liquidity. The liquidity is never guaranteed. It is typically gated. And in the generalized case, you keep a liquidity sleeve. It is gated to a percentage of the liquidity sleeve plus redemptions, plus new subscription money, plus distributions. Now, the one big catch about evergreen funds, which not a lot of people talk about, but sophisticated investors get really concerned about, is valuation of private assets. Now, in the venture capital industry, and Stepstone is a fund of funds which buys a bunch of different venture capital funds. In the venture capital industry, it is traditional to mark to last transaction. And last transaction in private markets will typically be every 1 to 3 years. Now, I've put up here, just for comparison, the stock price for Tesla. You can see a base of 100 up to a peak of sort of 400 here. And you can see public companies, the valuation varies dramatically over time. The problem you have as a VC marking to last transaction is when the company is doing well, you are underpricing. And in periods when the company's valuation is dropping, you end up holding it much higher value than reality on your books. So the challenge is that, look, if you price based on last transaction, which is easy to audit, which is easy to justify, it's easy to do. And look, traditionally, it didn't matter in venture capital because they were institutional funds. The fact, I've had people from the industry tell me, the fact that they change slowly in value is a good thing. It is considered a feature, not a bug, because the institutional investors who invest in them like the fact that you've got this very slow moving, sort of backwards looking valuations in their private assets. And that allows them to keep their returns looking more stable over time, rather than having the private assets jump around like all the public assets do. So that's great, where traditionally you can't trade in and out of the as sort of the closed-end funds. But when you start looking at open-ended funds that you can trade in and out of, valuation really matters. And you need to start thinking about how you set a true market price such that when the asset is dropping rapidly in value, you are revaluing it down below that last transaction, or vice versa. So that is a really big thing to think about. We've been doing this for a bunch of years. We think a lot about how to set a true market price. I mean, the first thing you need to do is these are private companies. You need to stay in continual touch with every portfolio company. And we've got a number of venture partners, including someone we like. I see Wendy Robert Robertson is on the call, but venture partners like Wendy, who are talking with a selection of our portfolio on a monthly basis to stay on top of what's going on with them, so we can A, set a true market price, and B, decide whether the company is in a state we want to invest more money in it right now or not. So that is a really important part of running these type of funds. I'll just wrap up here by saying, look, any provider, if you should really get comfort around the valuations that any semi-liquid fund you're considering investing in is doing. And here's one way, an easy way to backtest the prices. We look at every time a company raises money, you know what the valuation is because they just raised money at a certain price. You can then go back one quarter and say, okay, great, the company raised money at a certain price today. How do we value it at 3 months ago? Because the prospects of the company shouldn't have changed that much in 3 months. And let's see what's going on with that company. Now, in our case, this is our actual backtest results. I can tell you that about 25% of the time, our price is perfect. We are within a couple of percent a quarter before to where the company actually does the raise. 80% of the time, we're wrong. And the question is not, are you wrong? You're going to be wrong. You can't perfectly predict the future. But when you're wrong, are you biased more on the upside or the downside? And you can see here that for those companies where the valuation, the quarter before was not exactly the same as the round which was raised, you can see that generally speaking, around 70% of our companies, 70% of the time, we have underpriced them relative to where the round showed up. And around 30% of the time, we have overpriced them relative to where the round showed up. We think that's a fairly healthy balance. I mean, we're not trying to hit a certain percentage. We're just trying to value what we think the companies are worth. But you can see that we're doing a pretty good job of balancing off those different interests. And that's a sort of thing which can be looked at to see, can you trust the valuations that a fund is giving? So let me stop there. That's been a quick overview. As you can see, we run through what's going on in the market. Feels tough to raise money. Valuations are down. Yes, they're down because the venture capital industry as a whole, valuations have been down, returns are down. This is a horrible message if you're a momentum buyer who wants to buy what's recently high in the hopes it'll keep going high. But if you're a value investor, now's a great time to enter the early stage venture capital market. We've then given you an overview of why the market is performing the way it is. You've seen less money coming in to venture capital because less money has been going back to the institutional investors because IPOs have basically been frozen since 2021. They are now starting to revert. So you may see a change in this market. We've talked about how all people who manage money, us included, have started to wake up to the fact that there is a whole group of individual investors. Historically, we were all targeting institutions. We've started to realize that it's normal mom and pop investors control as much money as the institutions do, and maybe we should make a product which they need. We all know what that product is. Loyal launched one in 2018. Everyone else is launching them in 2021, 22, 23, which is you need liquidity. The only way you can do liquidity with illiquid private assets is through semi-liquidity, a semi-liquid fund where you have gates of some sort such that if too many people try to leave all at once, you partially gate how much money is leaving, but you still, in normal everyday operations, most people can trade in and out fine. So quarterly, semi-liquid, evergreen, open-ended funds is what people are looking for. These have been starting to happen primarily in private equity, credit, and real estate. People are starting to realize more and more that those make a lot of sense in other places like venture. Giving you the example of one US group which has raised over $2 billion with that sort of structure, with a different fee structure also because they're a fund of funds. And lastly mentioned, look, you're buying an evergreen asset, you need to really think about pricing. So that's a quick overview. And would love to stop here and take any questions people may have. So you can either raise your hand if there's a lot of questions or it looks like we're probably okay. You can probably simply unmute if you're curious and you want to raise any questions. So any questions, anything you're wondering about, both in what we presented or in anything else venture capital related? Yes, Rebecca.
Hi, Kamal. Thanks so much for the presentation you've given so far. So I know that Loyal invests a lot in companies that are targeting at least one of the UN SDGs through their business model. As I did my INSEAD MBA a couple of years ago, and I was part of the the ISIF team, and helping out with
Thank
the
you.
deal sourcing and screening process. And sort of climate sustainability impact investing is my sort of area of interest. So I've since the MBA, I've spoken to a few other people, both inside of and outside of the INSEAD community, who have been exploring setting up venture funds, exploring evergreen structures. I mean, and from the climate side of things, especially, I know there's been a lot of discussion around how, a lot of sort of climate technology might have a longer horizon than the typical short kind of closed-end VC funds would allow for.
Yes.
And however, kind of some pushback I've heard on the open-ended fund, the sort of evergreen fund structure, because I'm very much, on the side of I think we need a lot more evergreen fund structures, especially for climate. But some pushback that I've heard from people who've sort of investigated that space or even set one up and then had to close it, that a lot of the kind of the LPs that invest in venture, especially if that's a bit more on the institutional side of things, their mandate or the way they are set up and their expectation from venture funds is to have that predefined timeline of,
Yes.
this is the fund life cycle, this is, whether, that's 7 years, 10, etc. And that they're just not set up for evergreen structures. I think the name escapes me, but there was a climate VC fund, I think, based in Germany that did try to launch an evergreen structure, and they just couldn't fundraise enough
Yes.
for it. So I was just wondering your insights into the market. Are you aware of any kind of positive developments on the LP side of things, the more institutional side, that look into investing in VC? Like, is there
Sure.
more positive movement
Well,
toward?
yeah. And so look, I showed the slide earlier, which said that there's $16 trillion of institutional funds, 23% of which is allocated to venture capital, and there's 0.4 trillion of evergreen funds, of which 0.5% is allocated to venture capital. So that is precisely the challenge for someone launching a fund today is currently, if you're a venture fund, all the money is in institutional. It's not in individuals investing in evergreen funds. And in fact, there's a really funny thing. We talked with one of these fund of funds. So there's a couple of fund of funds. We talked in one based out of Munich, Germany, which runs a quarterly semi-liquid evergreen fund of funds. And we talked to them about investing in Loyal, and they said, "Oh, we only invest in closed-end funds." And it's like, well, you're an evergreen quarterly semi-liquid fund of funds, but you want all your funds to be closed-end funds. Why? But this is really, this is what happens. Look, financial services is a conservative industry. And the big problem you have in financial services and with institutional investors particularly is the lack of alignment of interests. They've got a different risk profile, and there's really a career risk. They don't get rewarded for making great investments. They get punished if they make a mistake. And the result is, and I've talked with multiple institutional investors over the past 7.5 years with Loyal, and we hear over and over, we love your strategy. How you invest is really interesting. How you select deals, how you allocate capital, the idea of reserving capital for the follow-ons, doing that on a competitive basis, not just a straight anyone gets a follow-on check, is really interesting. But our compliance team will never, they don't know how to do compliance on a evergreen fund. We don't know how to compare your returns against the returns of the other funds, because you're doing an ROI and they are doing an IRR, and you are marking to market, and they are very sort of backwards looking in their valuations. So it is I don't have good news. I mean, my advice to anyone who's doing a fund, but the good news is that people are saying the growth is going to happen in evergreen semi-liquid. That if you look ahead, sort of, I'm trying to remember the growth rate, but they're talking about something like a 30% growth rate of the market over the next 5 years. So you're going to see a lot of growth in the offerings here. It is primarily a product driven to individuals. And the challenge is, if you're raising a new fund, you can get one $10 million check from an institution, or you can get $100,000 checks from individuals. It's much easier, feels much easier to get the one check than the 100 checks. So yeah, it will change. My guess is forward-looking institutions in the next couple of years will start to look at evergreen, because it's good for them, because they can balance their money more easily. But I would say for mass adoption by institutions, it's probably another 5 years. So you either need to say, I'm doubling down on individuals, which is what Loyal has done, or you need to say, I'm doing a closed-ended fund. Perfect.
Thanks so much.
Oh, very welcome. Joe.
Me?
Yes. Did you have a question?
Oh, yeah. Do you oversee, well, I have two questions. One is, does Loyal invest globally, or just what's your sort of geographic footprint of your investing activities? And then second, do you ever see a closed-end ETF-like structure coming to isolate the stage of a funding round? So a seed ETF, an A round ETF, a B round ETF, stuff like that.
The ETF is a really good question. Since we launched, we've had people asking us about, hey, the early thing was just, why, rather than even going to an ETF, it was just, why don't you just put this on blockchain and raise money, raise money directly with tokens, tokenize the fund. I can tell you that our valuation exercise takes us about 2 weeks of solid work. So when you're spending 2 weeks solid work to do a valuation, we can only do that on a quarterly basis. And the second you have a listed ETF, then you start, and okay, great. I mean, we know we can value what everything's worth on a quarterly basis. How is it going to trade in between? What happens if the market feels differently, because the market has different information from us? We may know, for instance, that one of our portfolio companies has an M&A activity going on. We know it's close to signing, but nobody else knows that. We can't publicize that. So then you have the problem that the market will probably always trade at a discount to what you set, which can maybe be done. I mean, I'm saying challenges. I'm not saying it's impossible, but I see these challenges. Then we worry about insiders taking advantage. I mentioned one of our portfolio companies having an M&A. Well, do insiders in that then start to trade in your fund? And okay, there's ways to manage insider trading or chase it down, but these are some of the concerns I have about a listed ETF. And that's
I misspoke, and I apologize for that. We're oversimplifying it's an ETF, but technically be a closed-end trust that has quarterly liquidity. That's more of what I was taught. I misspoke on an ETF, because you can't price these things mark to market on a daily, hell, even weekly. It's a quarterly function, really. So
potentially, yes. Actually, that's not a structure I'm as familiar with, but yeah, that's certainly, I can see something like that working quite well. Yes. Then we get back to the regulatory question. because we are only allowed, for instance, to offer our fund to accredited investors, and you just need to see regulatory change to allow that. And I know in the US there is some regulatory movement that structures like this might be possible. But yeah, I can see it working and happening that way. Yes, and in fact, I think it should.
Yeah, that's what a closed-end trust is. It's a 40 Act wrapper, but quarterly for all the reasons that you've described. It's not an ETF, and it's not a closed-end fund without any all that's all locked up. So anyway, thank you. And what's your
your first question again?
Footprint? Yeah, your geographic footprint of your investing activities.
Yeah. So our view is that when people invest in if you think about the perfect product for individuals, Michael and I mean, we're the founders of the fund. We're experienced angels. We said, what could a fund do for us that we can't do for ourselves? Because I can invest in private companies all day long. I was doing it for 15 years. Michael was doing it for 20, 25 years. So what could a fund do for us that we can't do for ourselves? So I can find all the local deals I want, but I can't find deals in Africa, in Cambodia, in Mongolia, in Ecuador. So, but when I think about my public stocks, do I have 100% of my public stock in just the sort of US and Canadian markets? No, I don't. I mean, I learned investing 101, diversification, have some global, have some local. So we saw the gap in the market to give people that global access, because it's hard to build the global access for yourself. So we have the largest country we have allocated to is the US, and I think it's 16% of our portfolio. So 84% is outside of the US. We have 34% Europe, 30% North America, 36% outside of Europe and North America. So we are really, truly a global fund.
Very cool. Well done.
Excellent. And by the way, Rebecca, you were mentioning the impact side of the fund. We are not officially an impact fund, but because what we do is we source exclusively from 54% are INSEAD alumni. And INSEAD alumni have all been trained on business as a force for good. So they're trying to make an impact in the world. They're trying to start businesses to make a difference. And the result is that when we fund INSEAD alumni, we fund impact companies. And we also do have a negative impact screen, which is, I don't want to spend my time busting my ass helping companies succeed that are destroying the environment or destroying society. So we actually do a negative screen, which is companies need to be net neutral or better environmentally and socially. So it's funny, we've become an impact fund almost by outcome rather than, I mean, we've always had the negative screen, but we never set out to say we will only do positive impact investments. We just said we won't do negative impact investments is the way we've run the fund. And then 80% of them turn out to be positive impact. I saw there was a question here in the chat. Sorry, let me just find it here. Mike W was asking, do we have anything in LATAM? Yes, 5% of our portfolio is in LATAM. Question here from Bryce. Are you seeing any trends about innovating new early stage products that offer better liquidity to LPs, such as revenue-based funds? Look, the revenue-based funds question is a really interesting one. That was one of the models we evaluated early on when we were launching this fund. And for those who don't know, revenue-based models are saying rather than buying a percent of the stock, I do a deal which says I give you $100,000 now, and you give me 10% of your revenue for the next 5 years, or until I make 3 times my money back, or forever. But I mean, generally people want to cap the revenue-based deals. That, by the way, is the first problem. Is people generally, entrepreneur wants to cap a revenue-based fund, a revenue-based deal payout. But if you run a capped fund, your return profile is very different from an uncapped fund, because in an uncapped fund, we make large amounts of money in the deals where we get 10 times our money back or more. Whereas in a revenue-based fund, revenue-based funds work very well for debt-like investing, which is a low-risk investment. But there is a concern about doing a revenue-based model with a very high-risk investment, because your returns are generally capped. I mean, you can imagine if Google had done a deal when they launched what said we'll give 10% of our money forever to one of our early funders, there would have been a lot of pressure on them as they grew to tear up that deal. And there's all sorts of conflicts arise from it. So I love the revenue. I love the sort of the revenue-based fund model. I think there is a place for it, but I just find equity easier to deal with. There's a question here from Saeed Ahmed. Has AI moved the needle positively for Loyal? And if yes, what specific AI sectors and percent of allocations are in AI? AI has moved the needle very positively for a large number of our portfolio companies. Now, the question we have, I mean, I think if you look at our percentage allocation to AI, we officially have 8% of our portfolio is AI companies, but we probably have 40% plus who are very heavy users of AI. So for instance, we've got one company out of the UK, which uses AI for drug toxicity. And okay, great, you're using AI for drug toxicity. It's hard to call anybody who does drug toxicity anything other than a healthcare company. That's a healthcare company. But they are a company because they exist because of the AI capabilities they have to identify pathways of toxicity. And they're actually using this to help recover drug targets which failed in animal testing, but are actually non-toxic to human, for instance. But yeah, so we have 40% AI companies broadly, 8%. And yeah, it's been a wonderful thing for these companies. You can do things now with AI you could never do before. I mean, we've got, and that the other thing is, what do you call AI? And we have a number of companies which were doing big data, machine learning 5 years ago, and now they call it AI, and it's the same thing that they were doing 5 years ago. But it really, the amount of efficiency you can drive from AI is remarkable. One of the big side effects of AI has been one of our portfolio companies who is very ambitious, and I'll simplify it in saying they're trying to replace the browser. If you've never thought about the fact why you have apps on your phone, why you can't run everything through the browsers, because browsers are stupid and they can't do very much. So he wants an alternative platform which has all the capabilities built into the browser, so you no longer need to write an app. You can just sort of call the different functions within your browser-like interface to do everything. And when we talked to him when he was first working on the business, he said, I'm going to need to hire a team of 8 programmers. It's going to take me a couple of years to get this out. And he now turned around and said, maybe one other senior person is all I need. I don't need anyone else. Mm-hmm. So AI has been wonderful for the scalability of small companies.
Can I ask
please
a couple more questions? So on the fund inflow into Loyal, has that also moved the needle? And then basically a question that I know you may not have the answer for now is, where do you see the exits on your investments into AI?
Sure. In terms of the fund flows into Loyal, it's been they've tracked the industry, and it's something which I found very amusing. The fact that I mean, my personal money, I wasn't putting money into Loyal when it was at its highs in 2020, 21, and I've been putting money into it in 24 because it was like, hey, we're down at lows now. But I'm a value investor, and I've come to realize I'm a value investor. I like to buy what's cheap. I was talking to a buddy in the mining industry. Gold mining business. And he said, he was laughing. We were laughing together. He said he knows a mining company, a gold mining company, which passed on buying another gold mining company for $800 million when gold price 3 years ago, when the gold price was $1,400 an ounce. Now the gold price is $4,000 an ounce. And they just bought that same company. Instead of $800 million, they were willing to pay 12 or $14 billion for the same company. Because, and look, if you're a momentum investor, you'll say this makes a lot of sense. Gold prices are at 4,000 an ounce. This makes a lot of sense. And why would you invest at it? But he and I both look at this and go, why didn't you buy that company 3 years ago? So yeah, that is what we've seen. Is we raise money from individuals. Individuals tend to be herd-like behavior, which is you invest in whatever's recently high rather than looking for value, because that's a contrarian view. So your second question there again was?
Oh no, on the exit horizon for your own,
Exits.
yeah.
So
In the AI sector. Yeah.
Yeah. So the nice thing about running an evergreen fund is we don't need to think about exits when we run it. So we often tell our companies, good companies are bought, not sold. So sure, if you want to exit, think about who the acquirers may be, think about the metric sale value, start to focus on some of that, but don't feel forced to put yourself on a timeline. Run your business to be the most successful business you can be. And when the right buyer comes, that'll be great. Now, the nice thing about running an evergreen fund is we have investors. We've distributed, like we do distributions every quarter. I think last quarter the distribution was 1%, for instance. We had an exit in one of our companies. We took that money, we redistributed back to all of the investors. But we have investors in our fund who have doubled. Yeah, we have investors in our fund who doubled their money just because they said, "Hey, I want to exit now. I invested at $1 a share. I'm selling it over $2 a share. I'll take twice my money back. Thank you very much." So that is the nice thing, is that the investors have the freedom to get liquidity when they want it, or to stay invested if they prefer. And because we distribute the money out to investors before we fill any redemptions, if you're in the Class I units, you also have the chance to have a venture capital investment, which is a revenue generating investment that you have capital that you can choose to keep or reinvest as you like. Now, returns will always be spiky, but that is, yeah, it comes back to building the fund we wanted to build. So we don't spend a lot of time. Talk to my peers. They are experts on exits because they have to be, because they're shutting their fund down. And we don't have to be experts on exits. We're just saying, how do you build a good business? Good. Follow-up question here from Andrew. Out of your AI-focused portfolio, how many companies have progressed beyond their seed stage? That is a great question, Andrew, and I don't have the stats on that. We'll have to get back to you on that. So, yeah, throw me a quick email, kamal@loyal.vc, and I'll be happy to answer that question for you.
Thank you.
Good. Any last questions before we wrap up the call?
Kamal, Dave Smith.
Yes.
In addition to being a loyal LP, I'm also running an angel group out of Boston. Our biggest challenge is that we've struggled with our portfolio companies getting to Series A. And as a result, they're coming back to us, basically subsuming all of our dry powder for bridge rounds. Are you seeing any breakthroughs there in 2025? I'd just be curious. It's probably an unfair question, but I'm asking you to kind of read the tea leaves if you could.
It's a totally fair question, and I will give a contingent answer, which is this will change as IPOs happen. And there'll be a lag of 6 to 12 months after the IPOs. Now, the one catch you have in the US is the largest investors in venture have been the foundations, educational university endowments, and the university endowments are under pressure. So I think you will see a bit of that some of the money will recycle to institutions like pension plans who will put it back in, but some of that money which goes back from venture into foundations, I think is never coming back. But I would say, yeah, watch the IPO market, add 6 to 12 months, and that's when the Series A will happen. Look, we're seeing the same thing, which is we're telling all our portfolio companies, get to break even. Do everything you can to get to break even, because you can't count on that next round.
Yeah, I think that's fair. All right, thanks.
Very welcome. Thanks very much, everyone. Hope you found this talk informative. My colleague Cass will be preparing a recording of this, so do feel free to reach out to Cassidy at loyal.vc if you would like a copy of it afterwards. Been a pleasure to share the time with you today. Thank you.